What if I told you that a single mistake, one moment of human error, amplified by machines, cost the world more money in minutes than most countries produce in a year? That in the heart of the world's most sophisticated financial system, a tiny spark triggered $1 trillion inferno, exposing just how fragile our markets really are? This isn't a scene from a Hollywood thriller. It's the true story of the most expensive mistake in stock market history. A blunder so colossal that it changed the rules of global finance forever, and its shadow still hangs over your investments today. Let's set the scene. May 6, 2010. The US stock market is humming with the relentless energy of modern finance. Billions of dollars are traded every second. Algorithms, cold, fast, and emotionless, are buying and selling at speeds no human can match. On the surface, everything looks normal. But beneath, a storm is brewing. Suddenly, the unthinkable happens. In less than 5 minutes, the Dow Jones Industrial Average plunges nearly 1,000 points, almost 9% of its value, wiping out over $1 trillion in market capitalization. Blue-chip stocks like Procter & Gamble and Accenture are trading for pennies. Panic erupts. Traders stare in disbelief as the numbers on their screens collapse, and then, just as quickly, the market snaps back. Most of the losses vanish in a matter of minutes. But for many, the damage is permanent. This is the flash crash, a financial earthquake that shook the world's faith in the very system it depends on. But what really happened? Was it a cyber addict? A rogue trader? The truth is even more unsettling. It was a perfect storm of human error, technological complexity, and a market structure that no one fully understood. Here's how it unfolded. Earlier that day, a large mutual fund decided to hedge its portfolio by selling $4.1 billion worth of S&P 500 futures contracts. Now, this is a big trade, but not unheard of. The critical error was how it was executed. Instead of spacing out the trades to minimize market impact, the order was executed almost all at once, flooding the market with sell orders. This sudden, massive wave of selling was a red flag for the high-frequency trading algorithms that dominate the market. These algorithms are designed to profit from tiny, momentary price movements. When they detected this enormous surge of sell orders, their programming told them to do one thing: get out of the way. They instantly pulled their buy orders, effectively draining all the available buyers, or what we call liquidity, from the market. With no one left to buy, prices had nowhere to go but down. And as they fell, they triggered a cascade of automated selling. Other algorithms, programmed to sell when prices dropped below certain levels, kicked in, adding more fuel to the fire. Within minutes, the market was in an uncontrollable freefall. But the real culprit wasn't just a single trade. It was a system that had become so fast, so interconnected, and so dependent on machines that a small error could snowball into a global crisis. The flash crash exposed a terrifying truth. The world's most advanced financial markets could be brought to their knees not by war or recession, but by a glitch in the code. Contrast this with the crashes of the past. In 1929, the Great Crash was triggered by a speculative bubble and a widespread loss of confidence that took days to unfold. In 1987, Black Monday was fueled by portfolio insurance strategies that backfired in a panicked human market. But the flash crash was different. It wasn't about greed or fear in the traditional sense. It was about speed. The market had become so automated that a single mistake could ripple out in milliseconds, causing chaos on a scale never seen before. The cost was staggering. In those few minutes, more than $1 trillion in value vanished into thin air. Some investors lost everything as their stop-loss orders were triggered at the worst possible moment, forcing their shares to be sold at rock-bottom prices. Imagine having your life savings in a stable company, only to have it sold for 1 cent per share because of an automated order. Others saw their trades canceled or reversed after the fact, leading to years of lawsuits and regulatory wrangling over who was responsible. But the psychological impact was even greater. For the first time, investors and the public realized that the market could be brought to its knees by forces no one could see or control. The very machines built to make markets more efficient had become a source of immense instability. The aftermath was a massive wake-up call for regulators worldwide. They scrambled to understand what had just happened. New safeguards were introduced, like the circuit breakers you hear about today. These are automated pauses in trading designed to halt the market during moments of extreme volatility, giving humans a chance to step in and assess the situation. Rules for handling large orders were improved. And there was a renewed push for tighter oversight of high-frequency trading, but the fundamental challenge remains. As markets become even more automated and complex, the risk of another catastrophic mistake grows. Technology has made investing faster and more efficient, but it has also introduced new vulnerabilities, ones that are harder to predict and even harder to fix. So what does this mean for you, the individual investor? First, it's a stark reminder that no system is infallible. Even the most advanced technology can fail, and when it does, the consequences can be swift and severe. Never put blind faith in the stability of the system. Second, it highlights the importance of understanding how the market works. Not just the basics of buying and selling, but the hidden mechanics that drive prices and liquidity. Knowing about high-frequency trading and market structure isn't just for Wall Street pros anymore. It affects your portfolio, and third, it's a call to stay humble. The flash crash showed that even the smartest minds on Wall Street can be completely blindsided by forces beyond their control. No one has a crystal ball. But perhaps the most important lesson is about resilience. The market did recover from the flash crash, just as it has from every crisis before it. The investors who panicked and sold at the bottom were the ones who locked in their devastating losses. Those who stayed calm, understood their long-term strategy, and resisted the urge to react to the chaos were ultimately rewarded as prices returned to normal. In the end, the most expensive mistake in stock market history wasn't just a technical glitch. It was a test of confidence, patience, and our ability to learn from the past. As you navigate the world of investing, remember the story of the flash crash. Stay informed, stay cautious, and never underestimate the power of a single mistake to change everything. Because in the stock market, history has a way of repeating itself, and the next big error could be just a click away. Thanks for watching. If you found this story fascinating, make sure to like this video and subscribe for more deep dives into the events that shape our financial world. See you next time.